Hi, I'm Ty from Nav. There's a lot to cover here, so this particular video might be a little longer than usual. I hope you'll stick with me. As a small business owner 20 years or even 10 years ago, there weren't too many options available if you needed to borrow money. Today, there are more options available than ever before. Technology, among other things, has made it possible for businesses to access capital for a variety of purposes and business needs, making more borrowed capital available to small business owners. That doesn't mean, however, that it's easy or that anyone can get a small business loan. There are criteria that you're going to have to make depending upon the type of loan you're looking for. The biggest challenge, though, that small business owners face today is figuring out where to look for financing because many business owners look in the wrong place. Let's talk about what's available, some of the qualifying criteria for different types of financing, and where to look. Term loans are a good place to start. When most business owners think of a small business loan, this is what they're thinking of. And depending on the age of your business, your personal and business credit profile, and your annual revenues and cash flow, you have a few options. The first place most businesses look is the local bank. Whether you're looking for a conventional loan or an SBA loan, this could be a good choice depending on the credit profile you have and how long you've been in business. As a general rule, the SBA offers some financing for startup businesses, but don't expect the bank to roll out the red carpet for you because other than the SBA offerings, they generally don't. If you're looking for a startup loan from the SBA, you should have better than average personal credit and some kind of income to support the payment. For a general small business loan, most banks and credit unions want to see a personal credit score in the 700s, though they will sometimes consider a score as low as 680. The SBA's threshold is around 650. The bank will want to see several years in business and annual revenues approaching $1 million. The SBA isn't as strict on revenue and time in business, but if your personal credit score falls below 650, you shouldn't expect success with the SBA. Online lenders evaluate your creditworthiness a little bit differently than most traditional lenders. For starters, the time in business requirement is more accommodating to younger businesses. It's still difficult for an idea stage startup to get an approval, but if your business has been around for at least a year and sometimes as low as 6 months, you can get a loan. The personal credit threshold is also less stringent. A 600 personal credit score is the norm, but there are lenders who will even go lower than that. With that being said, traditional lenders like banks and credit unions, along with the SBA, offer some of the lowest interest rates and longest terms on their small business loans. Online lenders might not be the most expensive financing out there, but you should expect to pay higher interest rates and typically have shorter terms than a traditional bank. Online lenders tend to look very closely at your revenue and cash flow to determine if you have the financial ability to make periodic payments. If you can demonstrate the ability to make regular and timely payments, you will be more likely to gain approval even if you have less than perfect credit history, which is one reason why they charge a little higher interest rates. Speaking of periodic payments, though, notice that I didn't say monthly payments. The traditional monthly loan payment associated with most traditional small business loans is not the norm among online lenders, although there are some traditional lenders that are even going to an automatic weekly debit from your business banking account. You should expect more frequent than monthly payments from an online lender, which could mean daily or weekly payments. What's more, you should expect an automated ACH debit from your account at the appropriate payment schedule, whether it's daily or weekly. A business line of credit is next on my list, although it's my personal favorite form of business credit. The same type of qualification criteria applies to lines of credit as the term loans we've just been speaking about. They're both offered by traditional lenders and online lenders, but you should expect the credit thresholds to be just a little bit higher than a small business term loan. The reason is the increased flexibility of the credit line makes it more difficult for an underwriter to determine what your profile might look like when you access the line compared to what it looks like today. For example, following the financial crisis in 2008, many business owners say their credit lines were drastically reduced or cut. This was a reaction to the increased credit risk that lenders felt at the time, mostly traditional lenders, who had lines of credit out. And this type of financing was slow to come back because of the perceived credit risk. Fortunately, that seems to have been flipped on its head this time around as online lenders have brought back their line of credit products ahead of their term loan offerings. I've not heard the same thing about lines of credit from the banks, though. The reason I like business lines of credit is because you can access the funds as you need them. You only pay interest on the funds you access, and you can repay the balance on the credit line and access the funds again. If you have an occasional need for extra cash, a line of credit can be a convenient and seamless way to add a little extra cash to fund unexpected opportunities to increase ROI or meet a short-term cash flow gap or meet other financial obligations. Business credit cards are another good way to fill the need for short-term capital. I particularly like business credit cards for relatively new businesses because they're a good way to start building business credit, provided the card provider reports your credit history to the business credit bureaus. Not all of them do, so it's important to ask and make sure they do if you want to build your business credit profile, which I believe every business owner should be doing. The creditworthiness criteria is often based on your personal credit score, so if you have a good or exceptional personal credit history, you should be able to get a business card fairly easily. I like the idea of leveraging credit where it makes sense to free up cash flow for business expenses that can be better met with cash, particularly in an economy like we have right now. That's one reason a small business owner should investigate equipment financing. Because this type of financing is collateralized by the equipment you're purchasing, it's a little easier to qualify for than a traditional small business loan or an online small business loan for that matter. And almost any asset other than real estate a business owner uses to do business can qualify as equipment. Construction equipment, computers, office furniture, a pizza oven, or even the chairs in a restaurant can qualify as business equipment. Rates might not be as low as an SBA loan, but they are usually competitive with other types of business financing. The loan terms are often driven by the expense of the equipment being purchased and the expected life cycle of that equipment, so they'll probably vary. There are both online equipment lenders as well as equipment financing available from traditional lenders. Invoice financing and factoring are additional options for accessing short-term borrowed capital. Although they are similar, they are not the same. Invoice financing acts more like a short-term loan using your accounts receivable as collateral. Factoring, on the other hand, isn't really a loan, but is instead the sale of your AR at a discount to a third party called a factor. The factor will advance you a percentage of your invoices, collect from your customer, and then pay you the balance minus their fees once they collect. Factoring has been around for a long time and is a popular way to finance the textile industry, for example. If your business invoices your customers, factoring might be something to consider. I often use the example of the corner baker who does a cash business that might not be a good fit for factoring, but the baker that sells eclairs to all the large hotels in the area and is paid via invoice could be. Because the factor is collecting from your customer rather than you, the creditworthiness of your customers will be of more interest to them than your own credit profile. For this reason, factors often specialize in particular industries because they understand the credit practices of that industry and know what to expect. So if you decide to go this route, a factor that doesn't work with your industry might decline your application, while a different factor might not. A merchant cash advance, often referred to as an MCA, or a business cash advance, are also options. A traditional MCA isn't really a loan, but is rather selling your future business credit card receipts at a discount. If your business does a steady stream of business via credit cards, this could be an option for you, although they are typically substantially more expensive than other types of business financing. The MCA provider will make a daily debit from your credit card merchant account at an agreed upon rate until the advance is paid in full. The interest rates are high enough, sometimes even triple digit, that the daily automatic debit allows them to work with borrowers that have weaker business credit and personal scores below 600. Your payments will fluctuate based on your credit card receipts on any given day, which can be challenging for some businesses. This is very expensive financing, so my advice is to proceed with caution. Business cash advance, though similar, is not the same thing as a merchant cash advance. With regular and consistent periodic payments and a fixed interest rate, a business cash advance looks more like a term loan than an MCA. Interest rates can still be high, but this type of financing can still be considered a reasonable option to meet short-term needs for capital. Although I personally differentiate between an online term loan and a business cash advance, there are folks in the industry who don't make that distinction. Now, where do you access this type of financing? Aside from going into the local bank, if you have a credit profile, annual revenues, and time in business to qualify, your search will likely be primarily online. One option is to go directly to a lender's website, apply, have your application reviewed, and either approved or rejected. Another option is to visit one of the online portals for a loan aggregator like NAV to weed through those lenders that are unlikely to approve your application based upon the credit criteria and the verifiable data about your business that you provide. Once matched to a lender that makes sense for your situation, you can decide among the options available to you. Not all aggregators are the same, though, so in my opinion, you'll want to make sure you choose from one that doesn't sell your data to a third party, can make an accurate and actionable recommendation based on your business data, and has the ability to connect you to a lender who is ready and anxious to offer you a business loan. Finally, in addition to the options we've already talked about, there are other ways for a business with a thin credit profile or limited time in business to access capital. A loan from family and friends remains one of the most utilized ways to access business capital. Crowdfunding is also an option, and trade credit, though not a small business loan, remains one of the most undervalued forms of credit available to a small business. Thanks for sticking with me. I know this video was a little longer than I usually record. I hope the information is helpful to you. There is a lot more information about all of the options we've discussed on the NAV blog, so I hope you'll check that out. And otherwise, thanks for watching.